Picture a surfer for a second. Someone paddling out in the ocean, constantly scanning the horizon, trying to read those really subtle underlying shifts in the water.
Right, because they want to catch that one massive macroeconomic wave.
Exactly. And if they paddle for it and the wave breaks the wrong way, they don't just sit there and drown. I mean, they instantly bail, turn their board around, and paddle out for the next one.
Yeah, it's a style built entirely on momentum, um, timing, and just an absolute obsession with reading global tides before anyone else even sees the water moving.
Now, contrast that surfer with a geologist. The geologists, well, they don't care about the waves at all. They are walking along the shoreline with a magnifying glass, inspecting the ground, looking for a solid, unmoving bedrock.
Right, they want something so fundamentally dense and stable that you could build a fortress on it,
Yeah, you build the fortress, lock the doors, and just leave it there for a century.
which perfectly encapsulates two completely divergent philosophies for looking at the exact same financial ocean.
Welcome to the deep dive. Our mission today is an incredibly fun thought experiment. What happens when you take the portfolio of one of the world's most aggressive, top-down macroeconomic surfers, Stanley Druckenmiller, and you audit it using the strict, bottom-up rules of the ultimate value geologist, Warren Buffett?
It's such a cool concept.
Right. We have a fascinating source document to guide us today. It's a comprehensive analysis of the Duquesne Family Office's Q1 2026 13F filing.
And honestly, it really is a brilliant lens for looking at the markets right now. I mean, a 13F filing is essentially a mandated peek into a billionaire's playbook.
Oh, absolutely.
By running Druckenmiller's latest real-world moves through Buffett's historical filter, we get to see where pure momentum collides with pure value.
Okay, let's unpack this because the core tension we are looking at is massive. You have Stanley Druckenmiller, who, learned his craft alongside George Soros, and he is hunting for asymmetric setups.
Yeah, he wants extreme concentration.
Right. If he believes an entire country's political regime is shifting or a multi-year technology cycle is turning, he makes a highly concentrated bet. And if his thesis is wrong, his stop losses are absolutely ruthless.
He cuts the cord immediately.
Exactly. Compare that to Warren Buffett, who evaluates every single move through four very rigid tenets.
Right, the classic Buffett tests.
Yeah, so first, the business tenet, right? Is the company simple to understand, predictable, and protected by a durable long-term moat? Second, the management tenet. Are the executives acting as rational capital allocators rather than, empire builders?
Which is huge for him.
Definitely. Third is the financial tenet. He demands high returns on equity, massive profit margins, and crucially, minimal debt. And finally, the valuation tenet.
Well,
You must be able to calculate what the business is actually worth today and buy it at a massive discount to give yourself a margin of safety.
so basically, Buffett wants to buy and hold forever, while Druckenmiller wants to ride the wave and get off before it crashes onto the beach.
Exactly. So we have to ask you, listener, if you had to choose between being right about the global economy or right about a single company's balance sheet, which would you pick?
It's a tough choice.
It really is. Today, we're going to show you how you might actually be able to blend both frameworks. Let's start with the sheer scale of the changes Druckenmiller made in the first quarter of 2026.
Oh, wow, the volume was staggering.
It was. His total disclosed equities shrank by 24.8%, bringing his public portfolio down to $3.38 billion.
And that contraction is our first major clue about his macroeconomic worldview right now. I mean, he didn't shrink the portfolio because he suffered massive losses.
Right, this wasn't a forced liquidation?
No, not at all. This was a highly deliberate, strategic capital preservation move. He looked at the landscape, decided equity valuations across the board were getting stretched to uncomfortable extremes, and he just started hitting the brakes.
He shifted huge amounts of capital out of traditional stocks and into liquid assets.
Yeah, and alongside that, downside-protected options, like calls on the equal-weight S&P 500 and the Brazil ETF.
But the truly shocking data points, I think, are found in what he chose to sell to raise that cash.
Oh, the tech liquidation.
Yes, he completely liquidated his stake in Alphabet Google's parent company, just zeroed it out entirely.
Completely gone.
And he took an axe to Amazon, reducing his holdings there by 99%.
Meanwhile, on the buy side, he initiates a brand new, almost 200,000 share stake in Broadcom, while keeping a massive 6.9% weight in Taiwan Semiconductor.
So what is the through line there?
Well, if we connect this to the bigger picture, you were watching Druckenmiller's fast-flipping macro style operate in real time. Just a quarter prior, he was aggressively accumulating Alphabet.
Right, he loved it.
But his macro thesis evolved. He clearly believes that the mega-cap consumer internet search and e-commerce giants have fully priced in all their near-term artificial intelligence upside.
So the wave has peaked for them.
Exactly. The wave is moving. The real money is migrating away from the software companies exploring AI directly into the physical infrastructure required to run it. Specifically, custom silicon.
What the industry calls application-specific integrated circuits, or ASICs.
Spot on.
You know, it's tempting to use the old picks and shovels during a gold rush analogy here, but that feels way too simplistic for what Broadcom actually does.
Yeah, Broadcom isn't just selling generic shovels.
Right. If a company like NVIDIA is selling high-end, off-the-rack designer suits, Broadcom is the bespoke tailor. I mean, they actually move their engineering teams in with clients like Google or Meta for 8, 10 to 24 months.
That is a massive commitment.
It is. They take exact measurements of the client's data center needs, and they weave a custom chip architecture from scratch. Once you spend 2 years developing that custom fit with Broadcom, you're absolutely not going to walk across the street to a competitor just to save a few pennies.
And that bespoke tailor analogy is perfect for understanding why Broadcom passes Buffett's business tenet with flying colors.
Oh, the moat is incredible.
Yeah, that 18 to 24-month embedding process creates an incredibly deep structural moat. The customer lock-in is near absolute.
And their margins show it.
Oh, absolutely.
Mhm.
Broadcom's profit margins clearly reflect that pricing power. They're operating with a 68.1% gross margin and a 44.3% operating margin.
That is huge.
Right. They pulled in $8 billion in free cash flow in the first quarter of 2026 alone.
Okay, so the business model is a fortress. That covers the business tenet perfectly. But a castle is only a good investment if you don't overpay for the real estate and, if the foundation isn't built on IOUs. So how does Broadcom hold up to Buffett's financial and valuation rules?
It fails them spectacularly.
Miley, how bad is it?
Let's look at the balance sheet. Broadcom is carrying $63.8 billion in long-term debt, sitting against only $14.2 billion in cash.
Wow. That is a staggering amount of leverage. Where did all that debt even come from?
It comes from management style. CEO Hocktan built Broadcom largely through aggressive debt-financed acquisitions. Most recently, he swallowed up the massive software company VMware.
And Buffett notoriously hates that.
Yeah, he famously despises this kind of heavy financial leverage.
Yeah.
He generally prefers companies that grow organically rather than CEOs who act as aggressive corporate acquirers.
Which brings us to the valuation tenet. If they're carrying all that debt, I have to imagine the valuation metrics are heavily skewed.
Highly skewed. Broadcom is trading at a trailing price-to-earnings multiple of 81.53.
Yikes.
Right. Now, if you run a conservative discounted cash flow model, which, is a way of estimating a company's intrinsic value based on the cash it will produce in the future, Broadcom's fair value sits around $327.50 per share,
But what is the market pricing it at?
near $425.
Meaning buyers are paying a 31.3% premium over what the underlying math says the company is actually worth.
Exactly.
For Buffett, who demands a massive margin of safety like buying a dollar for 60 cents, paying $1.30 for a dollar is just heresy.
Broadcom gives us the perfect encapsulation of the two styles. Druckenmiller sees the AI hardware supercycle, recognizes the customer lock-in, and just buys the momentum wave.
Totally ignoring the premium price tag and the messy debt.
Right. Whereas Buffett would acknowledge the great business, look at the balance sheet and the price, and just walk away.
So if Broadcom's balance sheet gives Buffett heartburn, let's look at the companies Druckenmiller owns that actually have pristine, Buffett-approved financials.
Because ironically, those are the exact companies Druckenmiller is currently dumping.
Yeah. Let's talk about Taiwan Semiconductor, TSMC. They are the undisputed global leader in advanced semiconductor manufacturing. They are currently the sole commercial foundry capable of producing high-volume, cutting-edge 3-nanometer chips.
It's the ultimate toll booth business.
Right.
TSMC doesn't design the chips. They just build the factories. When Apple, NVIDIA, or AMD want to bring their designs into reality, they literally have to drive through TSMC's toll booth and pay the fee.
Here's where it gets really interesting, because the sources included a DuPont analysis of TSMC. And for anyone listening who hasn't spent years reading corporate finance textbooks, the DuPont equation is a brilliant tool.
It really is.
It basically deconstructs how a company is achieving its return on equity. I mean, you can juice your ROE by taking on a ton of dangerous debt, like we just saw with Broadcom. Or you can achieve a high ROE simply by having massive profit margins and running your assets with incredible efficiency.
And when you run TSMC through that DuPont breakdown, is a textbook Buffett dream machine.
Oh, the numbers are wild.
For the quarter ending March 2026, TSMC posted an annualized return on equity of 40.41%. But crucially, that wasn't built on dangerous leverage.
Right, no heavy debt.
No, it was driven almost entirely by their breathtaking 59.9% gross margins and just pure operational efficiency.
And we see a very similar dynamic with another company Druckenmiller has been holding, Woodward Inc.
Yeah, the aerospace compounder.
Exactly. They manufacture highly specialized control systems that are certified directly into the engines of Boeing and Airbus planes. The regulatory hurdles required by the FAA to replace their parts with the competitors are so high that Woodward essentially enjoys a permanent monopoly on those engine platforms.
Which is a massive moat.
Huge. It has a deeply conservative debt structure, steady returns on invested capital, and a business model any value investor could understand in 5 minutes.
So you have two absolute fortresses,
Right.
TSMC and Woodward.
Right?
But in Q1, Druckenmiller trimmed his TSMC stake by 8.8% and slashed his Woodward position by a massive 64.2%.
But if they are the perfect businesses, why on earth is he selling them?
It comes down to velocity and valuation. Let's look at TSMC. It's an incredible toll booth, but because the whole world knows about the AI boom,
Yeah.
TSMC was trading at a PE of over 38.
Which is high for them.
Yeah, that's 67% above its own 5-year average. By value metrics, it was trading about 42.6% above its calculated fair value.
So it just got too hot.
Right. Druckenmiller loves wide moat assets, but he manages them dynamically.
Huh.
When a stock's valuation gets entirely detached from reality, he doesn't sit there and hold it forever out of loyalty.
He harvests the cash.
Exactly. He pulls from mature, slower-moving industrials like Woodward and trims overvalued winners like TSMC, specifically to fund faster horses in the AI race.
He uses them as a funding mechanism. I mean, Buffett buys a great business and essentially vows never to sell it, willing to suffer through periods where it's overvalued.
Yep.
But Druckenmiller says, thank you for the massive 40% gain, but the wave has crested here. I'm taking my chips off the table and putting them somewhere with more immediate, explosive upside.
It is a tactical fluid adjustment versus a structural till-death-do-us-part marriage.
So Druckenmiller uses pristine cash generators to fund his macro bets. But we have to pivot now to the exact opposite end of the spectrum, because when you dig deeper into this 13F filing, you realize he isn't just buying cash-printing tech monopolies.
Far from it.
Right. He has massive positions in companies that burn cash, have zero current earnings, negative margins, and rely entirely on binary scientific outcomes.
You're talking about Natera.
Yes, I'm talking about Natera, which is currently his #1 largest equity holding. It makes up 19.5% of his entire portfolio.
Natera is a phenomenal case study in how macro traders define risk differently than value investors.
Because they dominate clinical genetic testing, right?
Yeah. Their flagship platform, called Signatera, is a blood test that detects microscopic fragments of tumor DNA floating in the bloodstream.
Wow.
It allows doctors to spot cancer recurrence months, sometimes even years, before a physical PET scan would catch a tumor.
The scientific implications of that are incredible. But if we are auditing this with Buffett's rules, Natera's financials look like a horror movie.
Oh, they are completely un-Buffett-like.
Right. If you look at their official accounting, their GAAP numbers, they are bleeding cash. They have a negative 15.02% return on equity.
And terrible operating margins.
Negative 12.68%. Because they are dumping over $600 million a year purely into research and development. How does a billionaire justify making a company that loses money on a standard accounting basis a fifth of his entire portfolio?
What's fascinating here is that Buffett wouldn't touch this with a 10-foot pole. There is no predictable intrinsic value, absolutely no margin of safety, and a forward PE that is literally negative 300.
So why is Druckenmiller in?
Because Druckenmiller is looking past the current GAAP earnings to see a highly durable structural moat being built in real time. Natera recently won a massive legal battle that secured a court-ordered 30% ongoing royalty on competing diagnostic products.
Oh, that's a huge barrier to entry.
Yeah. Furthermore, their years of clinical data accumulation feed directly into Medicare reimbursement approvals. That creates a regulatory network effect that new competitors simply cannot replicate.
So the moat is absolutely real. It's just temporarily masked by the massive R&D spending, so it isn't showing up in the traditional earnings per share metrics yet.
Precisely. And Druckenmiller applies that exact same asymmetric risk framework to his biotech holdings. He owns substantial stakes in Insmed, New Amsterdam Pharma, and Revolution Medicines.
Those are all clinical stage companies, right?
Yeah, completely pre-revenue. They fail every single one of Buffett's tenets because they have zero commercial history and massive cash burn.
They are entirely binary. If the FDA approves their drug, the stock rockets up 500% overnight.
And if the clinical trial fails to show efficacy, the stock goes to zero.
It is essentially a multi-million-dollar coin flip.
Well, to a value investor, yes. But to a macro investor, Clinical trials and shifts in Medicare reimbursement offer deeply asymmetric setups.
Okay, so how does he survive the downside?
If the science hits, the upside is exponential. And Druckenmiller manages the downside risk not by demanding a discounted valuation up front, but by utilizing mathematically rigorous stop losses.
So he just bails if it goes bad.
Exactly. If the clinical data shifts negatively or the thesis breaks, he doesn't hold and hope. He exits the position instantly.
That is a profound difference in the philosophy of risk. To Buffett, risk is the inability to confidently predict what a company will earn in 10 years.
Right.
But to Druckenmiller, risk is simply failing to cut your losses immediately when the data changes. And seeing him apply that asymmetric framework to cutting-edge science makes sense. But what blew my mind in this filing is that he applies that exact same framework to something completely primitive.
Digging raw materials out of the ground.
Yes, you're looking at his commodity and emerging marketplace. He increased his stake in YPF, the Argentine state-backed oil company, by a massive 433.1%.
And he also significantly increased his stakes in Alcoa, the aluminum producer, and ST Microelectronics.
Furthermore, he is holding a huge call option position on the EWZ, which is the iShares MSCI Brazil ETF.
Which again breaks every Buffett rule.
Completely. Buffett wants pricing power. He hates commodity price takers. I mean, Alcoa doesn't wake up and decide what it charges for aluminum. The global commodities market dictates that price.
And YPF doesn't set the price of a barrel of oil.
Right. And Buffett famously hates ETFs. He wants to do the hard work to find the one perfect needle in the haystack. He doesn't want to buy the whole haystack. So why is Druckenmiller loading up on Brazilian haystacks and Argentine oil?
Because these positions aren't bets on the specific companies. They are pure macro thesis expression.
Oh, I see.
Yeah, Druckenmiller isn't evaluating YPF based on its management's long-term capital allocation skills. He's evaluating it based on the aggressive macroeconomic deregulation currently happening in Argentina under President Javier Milei.
The political shift.
Right. Combine that political shift with the intrinsic value of Argentina's massive Vaca Muerta shale formation, and you have an explosive setup.
He's looking at the political regime change as the catalyst, completely bypassing the messy corporate governance. And what about the Brazilian ETF options? Why is he playing the EWZ?
The EWZ and Alcoa act as deep discount cyclical inflation hedges.
How does that work?
By using call options on the Brazilian market, Druckenmiller pays a small premium for the right to capture the upside. Brazil's economy is incredibly resource and commodity heavy. So if global inflation stays sticky and commodity prices rise, the Brazilian equity market acts like a natural parachute.
It catches the updraft of those rising prices.
Exactly. Emerging market equities and commodities often trade at steep discounts to their historical norms. Druckenmiller is buying the underlying assets at a huge discount to their replacement cost, totally ignoring the unpredictable business fundamentals that would drive a value investor insane.
He is buying the wave, not the rock.
Beautifully put.
No, Druckenmiller relies on massive teams of analysts and multi-agent tracking systems to spot these global macro shifts. For those of you listening who are doing your own deep dives and want to track market temperatures and valuation metrics yourselves, we want to share a specific resource. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for information and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you'd like to access wider topics including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
Yeah, it is absolutely crucial to have the right data frameworks when you're trying to process this kind of global complexity.
So, what does this all mean? We've just walked through the mind of a macro trading surfer, using the rigorous checklist of a value investing geologist.
It's been quite the journey.
We've seen Broadcom's bespoke AI moat paired with heavy corporate debt. We've seen TSMC's pristine debt-free financials being actively sold off because the valuation got too hot.
And we've explored binary biotech gambles and Argentine oil deregulation plays.
What is the ultimate takeaway for the listener trying to build their own portfolio?
The most empowering takeaway is that you do not have to choose just one financial religion.
I love that.
The most sophisticated capital allocators in the world are increasingly blending these two styles. You can hunt for those deeply structural, Buffett-style wide moats companies like TSMC or Woodward that have undeniable competitive advantages and immense pricing power.
But you don't have to be blindly dogmatic about holding them forever if the market valuation becomes completely detached from the underlying reality.
Precisely. You can pour the solid foundation of a geologist, but maintain the agility and situational awareness of a surfer.
You can own the highest quality assets, but manage those positions using Druckenmiller's macroeconomic agility.
Right. When a technology cycle turns, or when a great stock is suddenly trading at a 40% premium to its fair value, it is entirely rational to trim your exposure.
You can harvest that overvalued capital and reallocate it to areas with much better asymmetric setups, whether that's biotech or emerging markets.
Risk management doesn't just mean buying cheap stocks with low debt. It also means actively managing your exposure to structural trends and cutting your losses when the thesis breaks.
I love that synthesis. You can build a fortress, but you'd be a fool not to keep an eye on the weather forecast.
Yeah, exactly.
Now, before we wrap up, I know you always like to leave us with something provocative to chew on. Looking at how rapidly and aggressively this entire Q1 portfolio shifted, what is the final thought you want the listener to walk away with today?
Here's a question to ponder. Warren Buffett famously states that his favorite holding period is forever. But look at how fast Stanley Druckenmiller dumped his entire Alphabet position, a company most investors thought had an impenetrable search monopoly, just to pivot into the physical AI infrastructure of Broadcom.
It was a massive pivot.
Yeah. In a world where technological cycles, especially around custom silicon and artificial intelligence, are accelerating at light speed, is the idea of holding any business forever actually becoming the biggest risk of all?
Wow. If the ground beneath the fortress is shifting at light speed, maybe being a pure geologist is more dangerous than being a surfer after all.
It really makes you think.
That is a brilliant question to leave off on. Thank you all for joining us on this deep dive into the Q1 13F filings. Keep asking hard questions, keep connecting the macro dots, and we will see you next time.